Okay, so now how do we estimate our bad debt? There's two methods. There's one that we call the income statement method. In this book, they call it the percentage of sales method, and there's the balance sheet method, which is the analysis of receivables or the aging of receivables method. We're going to first talk about the percentage of sales method. The big difference between the two, obviously, is what accounts we're using to calculate the allowance amount. And the other thing is actually the journal entry itself. When we use the sales method, because the sales are for a period of time, whatever we calculate, we can just directly write the journal entry for that number. But for the balance sheet method, it's a little different. We actually calculate what the balance in the allowance account should be, not what the journal entry should be for. So let's back up and look at the percentage of sales method. So percentage of sales method, we've got some facts here for X-Tone Company. It says their balance in their AR. And the AR is $240,000. One extra zero, I think. Balance in their AR is $240,000. The balance in their allowance account, for doubtful accounts, is a credit balance of $3,250. Credit out here, make sure we know. AR would obviously be a debit balance. It's assumed since that's the normal balance. Total credit sales for this company was $3 million. And the bad debt is their estimate as a percent of sales was 0.75%, which is weird that they type it out that way. But understand 0.75% or 0.75% is really mathematically, if I put that in comma form, is really 0.0075 because it's 0.75%. Okay, so get that there. It's a little tricky how they're doing that in the book. It's not tricky necessarily, you just kind of pay attention to it. But 0.75%. So quite simply, all I would do if I'm using the percentage of sales method is I would take the total credit sales times this percentage to find what my journal entry needs to be for. So my bad debt entry amount is going to be the 3 million times 0.0075, which is 22.5. So my journal entry would be just kind of as it was before, bad debt expense would be my debit. I didn't put my debit code here. Would be my debit for 22.5, and my credit for 22.5 would be to the allowance for doubtful accounts. So if my balance in there was already 3,250 credit, then to find the balance after this journal entry, I had a credit balance in it, so I can take the credit plus the credit since they go in the same direction, and say that a balance after this transaction is 25,750. As long as I am doing the income statement method or the percentage of sales method, that's all there is to it. So I estimate it based on a percentage of sales. That is going to be my entry amount. Okay, and I'm being real specific about it because the one we're getting ready to do, the balance sheet method, is not that way. The number that we find through a calculation in that one is we find what the balance needs to be. So I'm looking. So the other method, we're finding this number, and this method, we're finding what the journal entry number is. So do understand that, and we'll get ready to do the analysis of receivables method next.